Nobody warned you about this, not the news anchors, not the politicians, not the guys on cable television yelling about stocks. Nobody sat you down and said, hey, there is something happening right now in America that could change your financial life for the next 10 years. So today, Jack the Prophet is going to do exactly that. My name is Jack. And what I am about to walk you through is the most important financial story of 2026. It is not about stocks. It is not about crypto. It is not about tariffs or trade wars or anything you have heard 100 times already. It is about the bond market, and it is already affecting you right now, whether you know it or not. Stick with me for the next few minutes, because by the end of this video, you are going to see the American economy in a completely different way. Let me start with a number, $38.6 trillion. That is how much money the United States government owes right now. That is the national debt, and it is not slowing down. It is speeding up. In just the first 3 months of fiscal year 2026, the federal government borrowed $601 billion in 3 months. Now, here is the part that keeps financial experts up at night. The government does not just borrow money once and pay it off slowly. It has to go back to the market over and over again and convince investors to keep lending it money. And the question right now, the one nobody in Washington wants to answer, is this what happens when the world stops trusting America enough to lend it money at a reasonable rate? Because, folks, that is exactly what is starting to happen. Before we go any further, let me make sure we are all speaking the same language here. You have probably heard the words Treasury yield or bond yield on the news. Most people change the channel right about then. And I get it. It sounds boring. But here's what it actually means in plain English. When the U.S. government needs money, it sells bonds. Basically, it says to investors, lend me your money for 10 years and I will pay you back with interest. The interest rate on that loan, that is the yield. When investors trust the government and feel confident about the economy, they accept a low yield, a low interest rate. But when investors get nervous, when they start doubting whether the government can manage its debt, they demand a higher yield. They say, if you want my money, you are going to have to pay me more for it. And right now, folks, investors are demanding a lot more. The 10-year Treasury yield has gone from 3.95% at the start of 2026 to 4.59%. By mid-May, the 30-year Treasury yield hit 5.19%. That is the highest it has been in nearly 20 years. Let me say that again, the highest in nearly 20 years. So how did we get here to understand that? You have to go back to a piece of legislation called the One Big Beautiful Bill Act. This was signed into law in 2025. It extended major tax cuts and added new spending programs. Now look, whether you supported that bill or not is not what we are talking about today. What we are talking about is the math. The Congressional Budget Office, which is a nonpartisan government agency, ran the numbers, and they said that bill would add somewhere between $3.4 and $4.7 trillion to the national debt over the next 8 to 10 years. That is not Jack talking, that is the government-owned accountants. And here is the thing about debt. When you keep adding to it, you keep having to borrow more to cover the interest on what you already owe. The federal government right now spends more on interest payments on the national debt than it spends on Medicaid, more than it spends on national defense. The Committee for a Responsible Federal Budget put out a report just weeks ago saying that interest costs are already eating up 19% of all federal revenue. 19 cents of every dollar the government brings in goes straight to paying interest on old debt. And if yields stay elevated where they are right now, those interest costs could grow from $880 billion today to $2.5 trillion by 2036. That is not a rounding error. That is a crisis. Now, here is where this story gets really interesting. There is a group in the financial world called bond vigilantes. These are not superheroes. They are not a secret society. They are simply large investors, pension funds, sovereign wealth funds, big institutions who hold enormous amounts of U.S. government debt. And when they think the U.S. government is spending too much, borrowing too much, printing money recklessly, they do not call a press conference. They do not write a letter to Congress. They sell their bonds. And when they sell, bond prices fall. And when bond prices fall, yields go up. It is their way of sending a message, a very expensive message. Two former U.S. Treasury secretaries, Robert Rubin and Larry Summers, recently wrote in the New York Times that inattention to the deficit is more serious right now than at any point in recent history. And Moody Ratings, one of the three major credit agencies, downgraded the credit score of the United States government. That is the same thing as your credit score dropping because the bank thinks you are borrowing more than you can handle. Except when it happens to the United States, it affects every single American. All right, let me bring this all the way home because I know some of you are thinking, Jack, this is all fascinating, but what does it actually mean for me? Here's exactly what it means. Number one, your mortgage, the 10-year Treasury yield is the backbone of U.S. mortgage rates. When it goes up, your mortgage rate goes up. Right now, mortgage rates are at a 9-month high, and a national debt watchdog group has said directly that the national debt is costing homeowners thousands of extra dollars a year because of its impact on mortgage rates. If you are trying to buy a house right now, the bond market is part of the reason it feels almost impossible. Number two, your car loan, auto loan rates follow the same pattern. Rates are up, auto sales are slumping, dealers are struggling. And if you are financing a vehicle right now, you are paying significantly more than you would have 3 years ago. Number three, your retirement. If you have a 401k or any investments in bonds or bond funds, rising yields have been eating into those values all year. Bond prices and bond yields move in opposite directions. When yields go up, existing bond values go down. Number four, your tax dollars. Every $1 billion the government spends on interest payments is $1 billion not going to roads, bridges, veteran care, schools, or anything else you might actually benefit from. And right now, the interest bill is $880 billion a year and climbing. This is not abstract. This is your money. Now, on top of all of this, there's one more piece of the puzzle that is making everything worse. The conflict between the United States and Iran. When that conflict escalated, oil prices jumped. And when oil prices jumped, everything gets more expensive: transportation, manufacturing, groceries, utilities. That is inflation. And inflation is the bond market worst enemy because when inflation stays high, the Federal Reserve cannot cut interest rates. And when rates stay high, borrowing stays expensive for everyone. And when borrowing stays expensive, growth slows down. Charles Schwab put out a report just this month saying that for the second half of 2026, inflation remains sticky and the Fed appears likely to stay patient. That is financial language for do not expect relief anytime soon. And Apollo chief economist Torsten Slok said something that I think every American should hear. He said that the volume of debt coming to market in 2026 is significant and is likely to put upward pressure on rates and credit spreads throughout the year. Now, I want to be straight with you. Most economists do not think the U.S. is heading toward an immediate collapse. But here is the thing about slow-moving crises. They do not announce themselves. There was a financial expert from Apollo Global Management who compared the current situation to what happened in the United Kingdom in 2022, when Prime Minister Liz Truss pushed through an aggressive spending plan and the UK bond market melted down in a matter of days. Her government fell in 44 days. The warning from that expert was simple. If the bond market loses patience with us fiscal policy, it will not wait for an election. It will not wait for a committee hearing. It will move fast and hard. The good news is that America still has the largest and most liquid bond market in the world. The dollar is still the global reserve currency. These things provide a buffer, but that buffer is getting thinner every year. And the people running the numbers, the nonpartisan accountants, the credit agencies, the former Treasury secretaries, they are all saying the same thing right now. This cannot go on forever. Okay, so what do you do with all of this? First, understand that this affects every financial decision you make right now. If you are buying a house, locking in a fixed rate mortgage sooner rather than later may protect you from even higher rates down the road. If you are investing, be cautious about long duration bonds. Charles Schwab said it directly: now is not the time to favor long-duration investments. If you have cash sitting in a savings account, high-yield savings accounts and short-term Treasury bills are actually paying decent rates right now because of all this. You can earn 4 to 4.5% on your cash without much risk. That is the one silver lining here. And finally, pay attention to this stuff. Not because you should be scared, but because understanding how money actually works in this country puts you in a position to make smarter decisions than the people around you who are not paying attention. That is what Jack the Prophet is all about. Look, folks, the bond market crisis of 2026 did not start overnight. It has been building for years through spending programs, tax cuts, wars, and pandemic debt that never got paid off. And it is not going to resolve overnight either. But now you know what is going on. Now you can see why your mortgage feels impossible. Now you understand why the Fed is not cutting rates. Now you know what bond vigilantes are and why they matter to your wallet. Nobody warned you, but Jack did. If this video opened your eyes, do me a favor, hit that like button, subscribe to Jack the Prophet, and share this with somebody you care about who deserves to know what is really going on with the American economy. New video coming soon. I will see you there.